Hello, and thank you very much for joining me for this presentation. My name is Brad Renard. I'm the Chief Publisher for Monthly Cash Through Options. This presentation is entitled Overview of the Iron Condor Pinnacle Strategy and Summary of Current Market Conditions. First thing I want to show is the chart of the S&P 500 Index, SPX, and as we can see, this is very choppy and volatile. In general, when I look at this chart from the beginning of 2018, this chart is a mess. Just to the next chart, this is the SPX. This is a weekly chart. So each candlestick represents 1 week of trade. This one takes us back to 2010, so we can get a lot more visibility into the SPX. And I also show the 1743 EMA. So this is the 17-week exponential moving average. This is the 43-week exponential moving average. And it does a pretty good job of either telling you if the market is in a confirmed long-term uptrend, as long as the 17 is over the 43. And then when the 17 drops below the 43, it's telling you the market is no longer in a confirmed uptrend and most likely could be in a confirmed downtrend. And we can see that how choppy this is in 2018. This is really a mess right here. And this was pretty bad right here. This was during 5 quarters of earnings recession when companies were not generating earnings. And this was very difficult to navigate. I call this really heavy, choppy, macro whipsawing market. Very difficult to make money in this type of market here. These are big moves also down here, but this one is really a mess, and especially this 20% correction in October, November, December of 2018. The Iron Condor Pinnacle strategy, let me just talk about the strategy first, and then I'll do a summary of what I see in the charts. Then I'm just going to spend a few slides on the Pinnacle strategy. The Pinnacle strategy is our most conservative income-generating strategy that is optimized for the following conditions. A U.S. economy that's been slowing and could go into recession over the next 12 to 15 months. And we saw the yield curve. It's flat and it actually recently inverted. The current economic expansion is the longest on record. It's very long in the tooth. And a slowing economy and going into recession is a gradual process. It's not an event. It takes many quarters to unfold. As a reminder, when we have a recession, it usually cuts stocks by 30 to 50%. Okay, the Iron Condor Pinnacle strategy is optimized for slowing corporate earnings that are currently projected to contract by minus 3.9% for Q1, and we're ready to go into earnings season in the next week, and for earnings to be flat in Q2 2019. This is a big change because earnings were really strong over the last 6 straight quarters, even 8 straight quarters. So this is a big shift. Condor Pinnacle strategy is optimized for a slightly expensive market. It's trading at 17.2 times forward S&P earnings. So this market is not cheap. It's optimized for continuous political uncertainty that can sell off stocks at any time. It's optimized for a choppy market that is difficult to generate consistent positive gains using stocks, ETFs, or indexes. For example, the S&P, SPX, and the NASDAQ composite indexes are close to their highs. They're about 1.2% away. So it's not recommended to buy just broad indexes because you have a minimal potential gain unless they break up through. And the probabilities of the indexes breaking up through these levels, at least right now, are pretty low. And in choppy markets like what we're in, buying stocks or ETFs takes a lot of experience in this market. It's easy to get chopped up. And the Condor Pinnacle strategy is optimized where we have a high probability that the major indices will hold below the all-time highs. That is at least until we get through Q1 earnings season, which starts in a couple of weeks. And if the indices break up through, then we'll adjust accordingly. And they might. I just don't think it's going to happen yet. Okay, for the Iron Condor Pinnacle strategy, we hold a maximum of 3 call spreads at any one time, representing a maximum of 30% exposure for the portfolio. Each position represents 10% of the portfolio and is open for 2 weeks. So for example, for a $10,000 portfolio, each trade holds $1,000. That represents 10% allocation. We plan to underweight on the put spreads, holding a maximum of 2 put spreads or 20% exposure of the portfolio at any one time. This strategy is conservative by construction. So allow us to sleep well at night as we overweight on writing call spreads against the stock market that most likely is capped to the upside, at least for now, and can have a major sell-off at any time. The targeted returns for the total portfolio are about 3 to 4% per month, and several of those months during the year could be 0 with no trades. Capital preservation is a top priority. So we have 15 years of experience in writing iron condors and credit spreads. And after going through some very volatile periods over the last 15 years, we believe it's best to keep the strategy conservative at all times. So not to be tempted to over-allocate. We're going to keep the allocation levels at 30% or less. We're going to be satisfied with returns of 15 to 20% annually. And in general, that's very good. It's very difficult to achieve those returns using most other strategies. And capital preservation is a top priority. So on the topic of trying to make positive returns in a choppy market, it is possible to make money buying stocks in a choppy market, but it takes a lot of experience and a lot of hard work. We have 4 directional stock buying strategies. Now these are long short, but mostly long, mostly buying stocks. We have a small and mid cap growth, a large cap growth, a sector rotation, and a contrarian. And the sector rotation strategy is up 7.5% as of March 29, 2019 after commissions. But the other ones are slightly down year to date, and it's been a lot of work. So it's taken a lot of hard work rotating into and out of many stocks because this market is choppy. So back to the Iron Condor Pinnacle strategy, here are the numbers. Here's an example of a total portfolio size of 10,000, which is the minimum for this strategy. A single trade allocation is $1,000. So we open up quantity 1 of a trade. It's going to be a credit spread or an Iron Condor. We typically will collect $100. We'll typically open 4 of those trades in 1 month, collecting $400, and that represents about a 4% return. So each trade is 2 weeks in duration. We layer the trades over time and strike prices. Usually we'll have no more than 2 trades open on one side, representing 20% of the portfolio allocated. This is constructed to be conservative, and capital preservation is a top priority. So overview of a bear call spread. Here's the chart of the S&P 500 index. We can see that after the 20% correction in late 2018, we bounced back pretty hard, very hard. This is a V bottom. And we're up over this 2875, which was the January high. And so now we're up in this channel. We're up in the 2875 up to 2930.40. So what we primarily sell are 2 week in duration, far out of the money spreads on this index, the S&P 500 index. So for example, as of April 1st, we would open the following trade. We would open up a April 18th, which is about 2 weeks out. We would sell the 2945 call, and we would buy the 2955 call for protection right here. So sell the April 18th 2945 call, buy to open the April 18th 2955 call. There's 10 points between those 2 legs. This 10-point wide spread holds $1,000 of maintenance of the portfolio. The trade brings in the credit of $1.10 or $110 for quantity 1. The potential gain of the trade is $110 over $890, basically $1,000 minus the credit, gives us a 12.3% potential gain. The trade allocates 10% of the cash in the portfolio, and the objective is for the SPX to stay below 2945, that's our short call, through April 18th expiration. And there's a very high probability that this SPX will stay below this level, and there is a high probability that the SPX will stay below this level for a while. And it might never break above this level until we roll over into our next recession. We don't know, and if it does break up through, then we have to adjust accordingly. But we can trade this level for a long time and probably make some really good returns. So if it doesn't work, we'll roll the spread out 1 week, and we'll push the spread up 10 points. Or if necessary, and if we believe the market is breaking above 2940 and it's already staying over this level for 2 or 3 or 4 weeks, then we'll flip the call spread into a put spread. And that's called adjustments. And we have a lot of experience in adjusting trades. What's different about this strategy, the Pinnacle strategy, is just we're going to have fewer trades. We'll have just 2 trades open, maximum of 3 trades open at any one time, and we're able to handle those adjustments pretty effectively. So high probability that the SPX will stay under the all-time high of 2940 for many months, especially through Q1 19 earnings season. And we'll continuously sell call spreads near the high of 2940 until the trade no longer works. Okay, let's look at the charts. 10-year Treasury note, interest rates around 2.5%. And this is what spooked the market. As interest rates drop on the 10-year note, you're flattening the yield curve. And the market was not pleased with this and sold off. The bond market is predicting that the U.S. economy is slowing and will continue to slow. The yield curve inverted, meaning that the rate of the 5-year was less than the 3-month. So for example, here on March 22nd, the yield curve inverted. These are the interest rates of the 1-month Treasury, 3-month, 6-month, etc., 5, 10, here's the 10-year right here, and the 30-year Treasury. In general, you want the slope to be upward sloping, and that represents a healthy economy. When you get this type of inverted yield curve, this is projecting that the U.S. economy is slowing, and sometimes, probably 80% of the time, the U.S. economy will go into a recession within 12 to 15 months. So back to the SPX index. This is a pretty ugly chart, but we are back up near the highs. We believe the probabilities of the SPX breaking up through 2940 are pretty low right now. As I already showed, this is the weekly and pretty ugly. It just shows you how volatile and choppy and toppy and sloppy this market is right here. And this is very difficult to navigate. Here's the Dow Jones Industrial Average, and looks very similar. So we're up near the highs. Here's the NASDAQ Composite Index. This has about 2,500 stocks in it. It's a good proxy for the overall stock market, and similar. So we broke up through 75, 77, and reasonable chance that this is going to try to grind higher all the way up to the top. And then most likely there will be a lot of selling, and for our portfolios personally, we're going to be selling into strength as this market is climbing up into 8,100. Here are the Qs. This is the NASDAQ 100. It represents 100 of the largest, mostly technology companies. And when this is climbing and it broke over this resistance level here, this is good news. It tells us that money is flowing into the stock market. Russell 2000 index, on the negative, this chart looks bad. So we can see the SPX rebounded, V bottom, went up to the 200-day line, hit resistance, sold off again, back up. This needs to get over 160 before we could feel comfortable that money is starting to flow into the small caps. And the mid caps look similar. So this still tells me that the stock market is not healthy. The economic data has been surprising to the negative. This is the Citigroup Economic Surprise Index. And we can see for 2018, it's mostly been rolling over, and it just recently took out some lower lows here. So that's not good on the economic data. And here's a note that we've showed in our analysis each week. We've been adding to it each time economic data comes in. It says on the negative, we've been basically experiencing continued shots across the bow from a 13% correction in January 2018, a 20% correction in November, December 2018, upward sloping 4-week new claims chart, a Fed that has decided to pause on raising interest rates, a European Union central bank that abruptly decided to pause on their monetary tightening, a flat to negative yield curve, a bad retail sales number, a negative Philly Fed reading, continued weak capital spending since August of 2018, a report showing increased auto loan delinquencies, analyst projections of negative earnings growth for Q1, a very weak February jobs report. Now, we just had a March jobs report that was good, so this has been negated. And now a negative PMI manufacturing report. So with this said, slowing of an economy is not an event. It's a gradual process, and it takes many quarters to unfold. The stock market looks forward 6 to 9 months, so it will become more volatile if the negative data continues to trickle in. On the positive, the most recent March jobs report was good, so this has alleviated some of the recession concerns for the economy. So where's this market going next? Stocks have been rallying in anticipation of a positive outcome of China trade and some positive economic data out of China. And Friday's jobs report was good. So that's a big relief because last month's February's job report was very weak. So the SPX is up to 28, above 2875, and now in this channel. However, high probability that the SPX will hit resistance at 2940, at least through Q1 earnings season. And for the Iron Condor Pinnacle strategy, we will be selling a few call spreads up at this top level until the trade doesn't work. And then we won't have a lot of exposure up there. We'll have just 1 or 2 trades maximum, representing 10 or 20% of the portfolio. So are we heading into a recession? Or another question, will the markets remain choppy and capped to the upside? If negative economic data continues to trickle in, then that won't help. But Friday's jobs report was good. And if Q1 earnings growth is negative and is currently projected to be minus 3.9% growth, that won't be good. And if we can't get China trade behind us to eliminate this source of uncertainty, then yes, we could be in a recession within the next 12 to 15 months. The expanding economy has lasted a long time, for 10 years, longest on record. A deteriorating economy is a gradual process. It's not an event. And as a reminder, when we do go into the next recession, then stocks will get cut by 30 to 50%. So how can I make a decent return on my portfolio in a choppy market and protect myself during the next recession? So if you want to learn more about how to make positive returns during a choppy market or a market with a downward bias, which we could easily have this year, or if you want to talk about how to avoid an unnecessary drawdown in your portfolio, or if you want someone to take a look at your existing portfolio to give you a second opinion, or if you want to learn what questions you should be asking your financial advisor if you have one. For example, how much will you allow my portfolio to draw down before you go to cash? Or what indicators do you follow to tell you to go to cash? Then please contact us. We're at support@monthlycashthroughoptions.com, or please visit our website at monthlycashthroughoptions.com. Thank you very much for your time, and I'll see you next time.